VWRP, FWRG, which is the better low-cost global ETF to invest if you want to invest into the global stock market? If you don't want to watch the full video, the short answer is they're both fine. They're both good options, but there are some specific differences between the two, and that is exactly what we're going to be covering in this video, including the fees, the holdings, the returns, the liquidity, and the tracking error. Luckily, there wasn't a sixth category there, or to run out of fingers. This is a question I've been getting increasingly often recently, so I thought let's make a whole YouTube video. And also, the way I'm going to compare these two funds, you can implement this specific criteria set when assessing two different funds yourself. If this is the first video you've seen of mine, hello, I'm Ryan. I'm a chartered accountant. That's the day job, and I also make content on the side through Making Money Simple. I myself am a global fund investor and have been since 2018. I've been making content about why global funds are the best way to invest since 2019. So making a video where we're going to be going in depth into two different popular global fund options is right up my alley. Or should I say, going straight into my basket. Before we get into the video, if you haven't signed up to my newsletter, it'll be the first link down below. Sign up and receive some weekly investing content straight to your inbox. I will never spam you, but I probably will make some bad dad jokes, so just be warned. One of the best ways to invest globally is to invest into an index called the FTSE All World. The FTSE All World is an index that tracks about 90% of the total investable world. So when it comes to companies that are listed in every corner of the world, the FTSE All World nearly tracks 100% of them. And this is absolutely brilliant because it means by following one index, the FTSE All World, you can get global diversification and you don't need multiple funds. However, if you actually want to invest into that index that tracks those companies, you need an index fund or ETF that will allow you to invest into those companies. Two options present themselves: VWRP, which is Vanguard's version, and FWRG, which is Invesco's version. They are both massive, reputable fund providers, so there's no problem with that. There's also a third option actually, ACWI, which if you want to look into, you can. And if you want me to make a full video on that comparison, just let me know. Firstly, fees. VWRP has an ongoing fee of 0.22%, whereas FWRG has an ongoing fee of 0.15%, making FWRG 0.07% quicker for those of you that done the mental maths. Fees are very important when investing because, of course, the lower your fees, the more money you have compounding over the long term. If you are running your own compound interest calculations and using, say, 7% per year, take off a further 0.07% and you'll see over the decades, it will add up to a little bit. It's not the biggest difference in the world, but of course, fees do matter. So we're gonna do a little sort of boxing contest. Floyd Money Mayweather and Conor McGregor, then FWRG wins that because it's a lower fee. Secondly, the holdings. Now this may seem like a weird one because aren't they both just tracking the FTSE All World? They are, but also they're sort of not. As per Vanguard's website, the benchmark, meaning the FTSE All World, has 4,246 stocks. VWRP invests into 3,654 stocks, which means VWRP is covering about 86% of the FTSE All World. However, as per Hargreaves Lansdown website, Invesco's option, FWRG, only invests into 2,396 stocks. I say only, it's still brilliant diversification, of course. But that is a much lower share of the FTSE All World, only about 56% of the total FTSE All World. So you probably know what I'm getting at here, but VWRP has much more holdings of the FTSE All World compared to FWRG. Now, it's not always necessarily realistic for these funds that are tracking an index to invest into every single company because it can be difficult and it does cost. However, VWRP is clearly doing a better job of actually tracking the index or the benchmark, which is the FTSE All World, in comparison to FWRG. So when it comes to the holdings and actually tracking the index, VWRP wins. However, number three, its size, and this is probably why VWRP won that last round. I've done a Morningstar fund compare and you can see the VWRP has been around since 2019, whereas the FWRG has been around for a much shorter amount of time, only since June 2023. So because this is a much newer fund, it's still probably taking the time to build up the assets in the fund, so it then makes more financial sense to buy more stocks in the FTSE All World Index, if you're following what I mean. So maybe after a few more years and once more money flows into the fund, FWRG will buy more stocks in the FTSE All World to get closer to the 3,600 plus that VWRP has. However, this size factor has another disadvantage for FWRG. Because FWRG has been around for a shorter amount of time, although it charges lower fees, it has less assets under management. As per Hargreaves Lansdown's fund page for FWRG, it has about 800 million of assets under management. This is in comparison to VWRP, which massively dwarfs it because it has 16 billion under management. Where am I getting of all of this? Why am I just plugging random numbers? The reason being is because FWRG is smaller and there's less assets under management, it then has a bigger spread. As you can see, once again, via Hargreaves Lansdown's fund pages, which have this information, the spread of VWRP is only 0.07%, whereas for FWRG, it's 0.16%. This point is slightly more nuanced, but spread is essentially the difference between the buy price and the sell price. So hypothetically, if you bought and then sold an ETF in the exact same second, you would make a loss, and that loss would be whatever the spread is. Generally speaking, smaller or newer ETFs have lower spreads because they're less liquid and are being traded less often. And ultimately, this spread, or as HL calls it, an indicative spread, is actually a hidden cost when investing. Now, I want to be honest, if you're simply just buying weekly or monthly and holding for the long term, this will probably have literally a negligible impact. But it is worth pointing out, and interestingly, when you add VWRG's fund fee plus the spread, it's actually higher than VWRP's slightly. It's only 0.02%. I mean, you know, it's a very small amount, but just pointing out the facts. So ultimately, because VWRP has been around for longer, it's got more assets under management, it's traded more, it's more liquid, so the spreads, which is a hidden fee of invested into stocks and ETFs, is smaller. Fourthly, returns. There's of course not much past performance to look at, not that it's a good indicator anyway, because VWRG has only been around for about 18 months. But if we do a Morningstar compare of the two funds over the last year, you can see FWRG has actually outperformed VWRP. Honestly, if you're taking a shot every time, even half a shot every time I say one of those acronyms, you'd be absolutely steaming by now. But you can see on this chart here, there was actually a 0.28% outperformance of FWRG. Why is that? The reason is because ultimately it holds less stocks, which means the very dominant stocks over the last year, which essentially is the Magnificent Seven, being Apple, Microsoft, Nvidia, and so on, have dragged the rest of the market up. That's a separate point for a separate video, but the actual less holdings in FWRG has actually slightly benefited the fund returns over the last year. I imagine over time, as the Invesco fund becomes bigger and starts having more holdings, the returns will converge, but actually over the last year, the returns have been better for FWRG. So I don't know if that counts as a point for FWRG, but technically it's got better returns. So I guess that's a point in that round. Which however brings us on to point number 5. And the reason for this outperformance is because FWRG has a much higher tracking error. The point of an index fund or an index ETF is to track the benchmark, track the index, track those underlying stocks. And this is where it also gets pieced together, these previous criteria, which is why I've left this tracking difference one to last. If we look at VWRP, because it holds the large majority of the stocks in the FTSE All World Index, the tracking error is only 0.02%, which says VWRP is tracking the FTSE All World very efficiently. However, given how new the FWRG is, there's actually no tracking error difference that I could find online. However, what's strange is, even though FWRG is not tracking the FTSE All World Index as well, because it holds over 1,000 less stocks than FWRP, and it holds only half of the stocks in the actual FTSE All World. This tracking error has actually benefited the fund because of what we mentioned previously about those big US stocks driving the rest of the market up, and it's actually resulted in a slight overperformance of FWRG compared to VWRP. I probably should have thought at the start of this video a way to distinguish between the two. Vanguard and Invesco would have been better, but I've spent 18 minutes now recording this, so it's too late. So whilst the tracking error has benefited the Invesco fund, as index fund investors or index ETF investors, we want to be tracking the index as closely as possible. So although it sounds counterintuitive, that point in that round once again goes to VWRP. So I think if we tally up the points, it's 3 points for VWRP and 2 points for FWRG. To summarize what we've gone through, FWRG has a lower expense ratio, a lower ongoing charge of 0.07%. However, FWRP invests into more companies. It actually tracks the FTSE All World better. It invests into 3,600 companies rather than 2,400 with FWRG. As a result, because it is larger, it then has lower spreads and a lower tracking error. However, FWRG because it hasn't got those factors, has actually outperformed FWRP over the last year. So which one should you use? I'm gonna be honest with you and say, whichever one is available on the platform you're using. They're both great funds. They both got very similar returns. And as particularly the FWRG grows, the returns and the holdings and the tracking error and the spreads will likely converge to be very similar to VWRP. And as that does happen over time, then the VWRG option will be better because it's lower fee. It's got a 0.07 lower ongoing fee. However, when comparing between two different ETFs, of course, that's not the only thing to consider as we've gone through these 5 criteria in this video. But ultimately, I appreciate it was a bit technical, a bit nuanced. There's a lot of small, very differences going on. Ultimately, they're both great ways to invest globally. If you want a global ETF, you can't really go wrong with either of them. Which is why I say, if you want to track the FTSE All World and use a global ETF, just use whichever one is available on your platform. And I guess if both are available, then you'll have to make the executive decision, and I'll leave that up to you. For me personally, I would probably go with the VWRP just because it ultimately won more points in how we compared them. But as I've said a couple of times now, you can't go wrong with either of them. And likely over time, if all other factors stay the same, the FWRG will become better because of that lower fee as it gets bigger. I hope you find this video helpful. If you want me to compare any other funds, let me know. Let me know your thoughts in the comments below. If you think I've missed any other important criteria when comparing funds, I'd also be interested to hear which fund you personally use. But before you go, make sure you also check out this video here for my latest portfolio update.